Okay, so this is the final part of the 4-part video series. I'm going to talk to you about the biggest problem that can stop everything working. And I have to say, it's nothing about investing, it's nothing about large cap, small cap or value companies, it's us. So here we go. You'll note I've still got my 1956 to 2018 date range on the top. I always use the same date. I'm going to draw a pound here. And we're going to say 1956. I'm going to repeat the dates to the back end of 2018. You'll recall inflation has been 5% over the same period. Just make sure there's an arrow to emphasize that. The effect of that inflation effectively grows the pound from 1 to 23, so 23 times. That's the effect of that annualized compounded inflation over time. You'll recall our asset classes. I'm not going to redraw them again now. Bonds, you'd have had £56. So the growth of a pound over that period with all those returns, effective returns have been 56. Just do bonds on that. If you'd invested just in the FTSE, the UK market, and I'm not talking about small cap or value now, I'm just talking about the whole market. If you'd invested in the FTSE, your pound would have grown to £850. If you'd gone in the value market, it had grown to £4,200, and I checked these figures in my book, they are accurate. And if you'd gone to small cap, your £1 would be worth £6,000 today, just under 5,885, I think it was. But there you go, there's the broad sweep. So you can see how this thing plays out. Now, I'm just going to now rub out bond and RPI. Our whole model's coaching you along the train of thought that you just have to expose yourself to global equities. Now, one of the things that can stop it dead in its tracks, your plan dead in its tracks, is the fact that they don't go up in this straight line, do they? So let's just rub out that, and let's draw what really happens. Okay, so I'm not talking now about specific markets. I'm talking about all three of them, which went up that way, as you saw. They do this, don't they? Okay, they move up and down. This is gyration of prices. This isn't risk. Risk is that when things are growing and everybody's happy and bouncing around, we're all ecstatic. Everybody's buying in, getting really excited, contributing higher levels of income and savings into stock markets. And of course, when we have the 5-year fire sale, economic crises and crashes, everybody gets unhappy and starts panicking and selling out. And it's in these windows here that all the damage gets done. Now, I can tell you that, again, I was born in 1972. The year after I was born, we had the 73-74 stock market crash. The Heath government fell apart. There were lots of problems and markets diminished. I can recall just before joining Barclays in 89, we'd had Black Monday. That was October 87. Huge economic depression, crashes. We come through that. We had Iraq invade Kuwait in 92. Huge problems with oil, etc. there. You come through the rest of the 90s with high interest rates. You've got the tech stocks that burst at the end of the 90s into the year 2000. Terror attacks in 2001, 2 wars in Iraq and Afghanistan in 02, 03, 04, 05. And just as you're coming through that, you've got the global financial crisis. So all of these dips can be tracked back. They're just stock market events which have defined our economic cycles and so on and so forth. We can't do anything about those, but the thing to remember through everything is that the falls have always been temporary and the rise has always been permanent. And ideally what you do is you stay in for the long haul, and if you can, you contribute along the way too through pound cost averaging. So some months you're buying units in our funds when prices are low, so you're buying more units, and you're buying fewer corresponding units when prices are high, so you get a nice balance over the course of time. The ideal is you double up on your contributions when things fall too. as any successful investor will tell you, you don't look in a rear view mirror, you look forwards. And the other thing is stick in equities because it's what works, and double up on your pound cost averaging when things do depreciate. So that's the behaviour necessary to have a successful experience. It's about the longer term, it's about accepting that the benefits of equity investing, which will see you through a 30-year window of retirement, where you'll see living costs rise 3, 4, maybe 5 times. You'll be able to manage that and live a life without running out of money. But there's always a price to pay, like everything else. And the price is that you have to just accept the sometimes temporary decline and reduction in prices. It's not a loss, you don't lose any money, but you will if you crystallise and sell when prices are low. Our clients don't, because we educate them against doing that, and they do trust us. So that's something that we spend a lot of time on as we go forward in our relationship. All of that's really important, but don't forget, it all comes back to your number. What's the amount of money you're going to need to live on in the future over 30 years? If you haven't got that worked out, you need to speak to us. If you think you've got it worked out, you want to cross-check it with us. And one thing you do want to do, obviously, is check that your investments and pensions and your ISAs and so on and so forth are doing the jobs that they should be doing, and you're not paying those huge fees for management that doesn't always work. Certainly doesn't work in 80% of cases, the speculative, active approach. So give us a call. We look forward to speaking to you soon. Bye for now.